Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at another of the larger companies on the S&P 500, Broadcom Incorporated, ticker AVGO. This one, it's probably going to be a pretty quick video. Incredible fundamentals and growth, but the evaluation is just too high right now. It's one of those companies that is really good and a lot of people know it, so they're willing to overpay for it. As a value investor, that's not really what we do. So I'd like to dive into these numbers here and figure out what price we should pay for it. So I'm coming up with a fair value around $129. Discounted cash flow is $152. Currently, it's trading for $179. Earnings yield looks a little high. For what we're paying, we'd want to see $8.98 in EPS. This year, analysts are projecting $4.85. Next year, $6.19. So it looks like it's trading at valuations 3 or more years out, assuming best case scenario. Cash flow yield, 49.23%. Incredible. On average, we're looking at 48.86, so this is a really strong cash flow company. Dividend 1.12, a little low, way lower than the average, which shows you how much it's run up. I mean, in the last 52 weeks, it has been as low as $90. That would have been the perfect time to buy in. That 52-week low lines up almost exactly with our margin of safety. So it does look like it's a volatile one. ROE, really strong, 58.7. ROI, 10.89. ROA, 9.33. All of those are super good. We do need to look at the debt to equity with such a high ROE, and we're seeing 2.04. So it is being skewed a little bit because they have more debt than we'd like them to. We'd like to see them pay off about $25 billion worth of debt to shore up that balance sheet. But cash flows are super strong. Margins are super strong. It's not a worst case scenario that they do have more debt than we'd like. Like I said, margins super strong. 68.93 on average, 63. Net margin, 39.31 on average, 26.9. Those are incredible. And then the PE really shows how overvalued this stock is right now. 37.02 PE. Earnings growth rate, according to analysts, 27.63%, which gives it a price to earnings growth of 1.34. So it is definitely overvalued by all metrics, but strong fundamentally by cash flow, margins, balance sheet is iffy. That's what I'm seeing on this stock. We have our matrix here where we put together all of the numbers for the past few years, and then we come up with our thesis. So we're looking at revenue growth wasn't anything crazy over the past 3 years, 14.5%, but analysts are projecting 44% this year and about 30% next year. So if we go with 30 to 35 for our thesis, we can see where that puts us in the next 3 and 5 years. Share count, they do issue shares, slowed down quite a bit in the last 2 years. So we're going to put something more in line with what we've seen in the last 2 years. Ideally, they start buying back shares with those strong cash flows, but we shall see. I wouldn't be surprised if they continue to issue them to get some cash with all of that debt that they have. But interest rates improving will help with that debt. Cash flows, we're going to put essentially in line with revenues. It'll take them up to a 47.4% cash flow yield in the next 5 years. Assets, they have been selling off 1.4, 1.2. We'll go with 1.2 for our thesis. Liabilities, they have been paying those 2%, 1.14. So kind of in between those, 1.4 for our thesis. Dividend is slowing down, of course. It's a larger number. If they continue at a 5.5% dividend growth rate, we're getting up to $2.63 per share in 5 years, and that at the current price is a 1.5% yield on cost. So definitely not a dividend stock here. Clearly a growth stock. Margins, we're assuming they hold flat. They're probably more likely to come down. I mean, 39% is a lot higher than 27 average, but this is kind of a better case scenario that we're looking at. So this better case scenario is giving us 27.5% annual growth. After you factor in the dividend, you're looking at about 28.7. So that is really good. But you are overpaying for shares and you end up underperforming the market in the 3 and the 5 year time frame. Unless they can outperform this scenario, which is very strong to begin with. I do not see that happening. In fact, I think we need to come back through and create a more reasonable scenario, bringing a lot of things down. 30% is on the lower end of what analysts are expecting. It's probably going to continue to decline from this 2-year point. So we are putting in a compound annual growth rate. 30 might be a little high, but we'll see what this gives us. Share count can hold flat. Cash flows, 29%. Assets, liabilities, dividend, those all seem to make sense. Margins, let's bring those down a little bit. And that scenario gives us 22.4% returns annually. After factoring the dividend, 23.5%, and you are underwater in the 3-year and the 5-year. Not only underperforming the market, but you are losing. The fair value at that point is less than what you're paying for your shares. Like I said, it looks like it's trading at valuations about 4 years out. So if it's still doing that at that time, you'll be okay. But it's a bit of a gamble. If Intel boosts their chip production, Amazon makes their own chips, how things are looking in that sector right now, it doesn't really look good for Broadcom. So I'd bring this scenario down even further. Let's say 25% revenue, 24% cash flow. Those all look okay. Bring the margins down more because they have to compete. In this scenario, you're still getting higher than market returns. 16.4% higher than that 10% we'd expect from the S&P. After dividends, 17.5%. Super strong. But with all that growth, so in this scenario, we're looking at 18.5% returns. Still beating the market returns of 10% that you'd expect from the SPY. After you factor in the dividend, 19.6%. But you are still, of course, even more underwater than you were previously because we lowered a lot of our numbers here. At the end of the day, clearly this is not the price to pay for the stock. We'd want something, if you buy in around 120, there's a reason that we factor in a margin of safety. If you can get in around $85, $90 at our margin of safety, that's the ideal place. Where even a worst case scenario, you are outperforming the market. I only buy stocks for my portfolio at prices where they're at my margin of safety, and I have greens across the board. So the PE and the PEG could be fixed if the price comes down. I mean, I could run the numbers real quick and see what that would be. At that price point, you're looking at around a 14 PE, much more reasonable. 15 around there is ideally what we'd like to be paying for a company. And a PEG, a price to earnings growth ratio of 0.5, which is amazing. From there, the only other thing that they'd really have to work on is that debt. They are paying it down faster than they are selling off their assets. And they can take some of that strong cash flow and some of that money from issuing shares and pay it off as well. So I'm not too worried about any of that. I'd say this one gets watch list potential, but I'd want to see a much better valuation. So taking a look at everything graphed out, we see balance sheet super flat. Earnings, we have some nice linear growth. The fair value has some great linear growth, as does the dividend, but it's a bit more flat, as does cash flows. Very similar to the earnings and the fair value. But then the price. The price was super fair back in 2020, really close to that fair value, smack dab into the middle of all the valuation metrics. Kind of ran up a little high in 2021. 2022 was a bit more reasonable. 2023 started to grow insane, and it is not reasonable whatsoever as in 2024. So they definitely are part of that AI hype, and I don't see a scenario where people paying for today's price end up ahead in any way. So please don't make that mistake. Don't buy into the hype. Set your price target and buy in once it reaches that. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.